Good morning, happy Sunday, and happy belated Thanksgiving from frosty Chicago. I'm John Kosar, Chief Market Strategist at Asbury Research. Thanks for viewing our latest Following the Money podcast. Today's date is December 1st, 2024. Today I'll be talking about what Asbury Research's latest data-driven market research and quantitative models are saying about current financial market conditions as we head into the end of the year and into a new year, 2025. In today's podcast, I'm going to show you some of the key charts, market metrics, and latest signals in our own quantitative models that we believe are likely to be the most influential in determining where this U.S. stock market goes from here. If you're not familiar with us, what makes Asbury Research different from other research and asset management firms is that we are completely data-driven. We are data analysts rather than prognosticators or forecasters of the future. As such, we do very little predicting because, at best, predicting is always just an educated guess. Our focus is on interpreting the latest data as indicated by our own models and on understanding which data series to be focusing on right now to determine what the market thinks, because the market's opinion is the only one that really matters. And when the market changes its mind, we can see that in our data. It shows up in our models. And it helps us to be agile enough to change right along with these changes in our models rather than getting married to a previous prediction that we may have made a couple of weeks earlier or maybe made one on TV or somewhere on the internet. Keeps us flexible, and it keeps us following the market and not trying to support a position that we made, an idea that we had 2 or 3 weeks ago, from which the market may have already moved on to something else. Asbury Research is a registered investment advisor, an RIA, that has been providing both investment research and asset management to individual and professional investors since 2005. It's our 20th year. To get more information about us, visit asburyresearch.com and click the Contact tab, which you can see right here at the top of your screen, or you can just click the link in the description of this video. Finally, if these YouTube videos are useful to you, please like and subscribe. Now, let's follow the money by identifying our key areas of focus as we look towards the end of the year. First thing we're going to talk about is tactical direction according to our Asbury 6. So we're going to move here to the Research Center, which is the password protected part of our website, and we're going to go to the Asbury 6, and there it is. For those that don't know about the Asbury 6, haven't been tracking us, Asbury 6 is our daily updated risk management model that looks beyond the day-to-day volatility and noise of the stock market to determine its actual daily health. We kind of equate it to when you go to the doctor's office for your annual physical. The doctor watches you come into the office, and he may make an observation on how he thinks you look, if you look healthy or not. Then he sets you up on the table, and he starts checking your pulse and your blood pressure and listening to your heart and lungs, and he gets a much better, a much more accurate indication of how healthy you are. And this is really what the Asbury 6 does for the market. Right now, the Asbury 6 is all green. All 6 of these metrics were back tested by us years ago to find a group of tactical market indicators that told us the real health of the market, so we don't get sidetracked by what's become more and more common is the market opens up 50, it's down 50 by lunchtime, and it's up 30 by the close. It's so easy to get knocked out of a good idea when you're dealing with this kind of noise that happens during the day. So that's what the Asbury 6 is supposed to do. So right now, all 6 are green. We've got the rate of change in the S&P 500, relative performance of stocks and high-yield bonds, investor asset flows, volatility, trading volume, and market breadth. And we back-tested these because they're different. No matter what indicator that you have, whatever indicator you're using that's your favorite indicator, every one of them is fallible. Nothing works all the time. I don't have a favorite indicator. I get asked that all the time because nothing works all the time. So we found 6 indicators that looked at the market from 6 different angles, and they're different from each other. So while 1 or 2 might be giving you a bad signal, the other 4 will pick the other 2 up and give you a more correct indication of health. Right now, everything's positive. You can see that these indicators started turning positive as early as November the 5th and as recently as the 21st. So right now, everything's positive and pointing up. That indicates going into next week and going into the near future, the market is in a pretty good condition to keep moving higher as we get towards the end of the year and everyone starts to talk about the Santa Claus rally. The next thing we're going to do is get an update on our SEAF model. That's our sector rotation model. Quantitatively indicates where the money is going and where it's coming from in sector rotation. So let's move over to the SEAF model. And here's the SEAF model here. Scrolling down to the graphic, which is what we're going to talk about. So for those that aren't familiar, the SEAF model is a completely data-driven sector rotation model. SEAF is an acronym for Sector ETF Asset Flows, SEAF. The SEAF model was created to quantitatively identify long and overweight opportunities in U.S. market sectors by following the acceleration of money as it's moving around the 11 sector spiders. Here they are here. If you add them together, they comprise the S&P 500. The SEAF model is always fully invested in the market, providing investors with a dynamic alternative to the traditional buy and hold portion of your portfolio. Instead of always having a piece of your portfolio that might be the S&P 500 or some generic index, we are always in those three sectors where the money is going to. Right now, you can see the money is going into financials, consumer discretionary, and industrials. We have a scoring system here that we won't get into just because of the longevity of the, I want to try to keep these from getting too long. But the top three right now are financials, consumer discretionary, and industrials. And since 10/28, consumer discretionary, XLY, since October 28 has been one of the top three. And we're always looking to take the top three in our SEAF model. Since 10/28, XLY has risen by 10.5% outright, while outperforming the S&P 500 by 6.5%. So that has worked. It's made us some money over the past month. And then since 11/4, November the 4th, the financial sector, which you can see is right on top here, has risen by 10.9% while outperforming the S&P 500 by 4.9%. This is how this works. This identifies where the money is going. That's where we want to be, and we want to avoid the places where the money's coming from. You can see these down at the bottom in red. Energy, healthcare, and technology. Basically, our model shows us that as the money is moving around, the 11 sector spiders are moving around the S&P 500, the money is coming from energy, healthcare, and technology and going into the top three, which again are XLF, XLY, and XLI. Next, here's an update on how our models are doing year to date and since inception. So we're going to change views and we're going to go right here. This is something that we update once a week at the end of the week just to see how we're doing. So here's our CPM, which is a correction protection model. That model is a risk on and risk off model. It's basically a dynamic version of the stock and bond allocation, which if you've been working with an advisor, you're probably familiar with. He may have identified you as a 55-45 stock bond person based on when you're going to retire and what your risk tolerance is and how much money you have. What we do is let the market tell us whether to be in stocks or bonds rather than the set it and forget it determination that they make. We think there's better tools out there, and CPM is certainly one of them. So year to date, annual total return, the S&P 500 is up 25.76. CPM is trailing it slightly by 3% with 22.69, but the maximum drawdown only 580 in CPM instead of 850, 8.5, only 5.8%. Standard deviation is a little bit lower, and our beta is a little bit lower. So we're staying right with the index with less risk. Here is how we're doing since inception, which is Q4 of 2017. Annualized total return for the S&P is 12.92. We're right on top of it at 12.79, effectively the same. But the maximum drawdown during this period for SPY was 33.9%, let's call it 34, and only 20% for CPM. So the maximum drawdown was 40% less. Why does that matter? Because whatever your maximum drawdown is, that's where you have to begin again to try to reclaim whatever open profits you had in the market before the market started to correct lower. So, and if you're starting to draw, or if you're planning to draw off of your accounts as you retire, smaller drawdown, it means you can get back to where you were faster and keep most of your money inside your account. So let's standard deviation again, only 12% here historically again since Q4 of 2017 versus 17%, let's call it standard deviation for the S&P. Beta is only 0.6, almost half of the S&P, which is 1. Let's take a look at our CEF model now. CEF model, year to date, total return, S&P, of course, we said 25.76 as we did here for SPY when we were looking at CPM. CEF is up 24, let's call it 24.1. So it's trailing by 1.7%. But again, we got a lower drawdown, only a drawdown of 5.7% versus 8.5% for the S&P. Much lower beta and slightly lower standard deviation. Here's why CEF is such a solid model. Let's look at since inception here, which is June of 2018. Annualized total return for the S&P is 13.11. For CEF, it's 21.4. It's 8.3% annualized better than the S&P 500 with very similar standard deviation, with actually about 4% smaller, 4.5% smaller max drawdown and slightly lower beta. So that's how our models are doing year to date. I think solid performance with less risk. Finally, the last thing that we're going to do today is I'm going to introduce a new product. This is our Asbury Research sort report. This is going to be part of our Substack offering. If you're familiar, if you're not, if you go to asburyresearch.substack.com, you'll be able to see the current offering. So the sort report is, SORT is an acronym that stands for Strategic Opportunity Radar Tracker, SORT. The SORT report applies Asbury Research's data-driven tools to a basket of 10 ETFs that represent a broad range of asset classes, including bonds, commodities, emerging markets, technology, and broad market indexes. So what we're doing here is each of these ETFs is graded in 3 criteria: by trend, by relative performance, and by money flows, with green indicating a bullish condition and red indicating a bearish condition. The SORT report allows users to quickly identify opportunities at a glance by focusing on the ETFs that are all 3 green across, which represent market direction, the acceleration of the trend, and the conviction to hold the position overnight. This combination points to what we believe are the strongest opportunities in the marketplace. So you can see right now, the 2 that have green all the way across are the U.S. broad market, which is SPY, and also U.S. small cap, which is IWM, iShares Russell 2000 ETF. And then we progress lower from there. Some of these have 2 out of 3 green, and then we have all 3 red down at the bottom with crude oil. So with the SORT report, you can watch as these sectors transition from unfavorable to favorable, providing early insights into emerging opportunities. So like we're looking at emerging markets here, or gold, that are maybe only 1 green. Once you see these start moving up the rankings here and all 3 are green, that's telling you that when you're buying that ETF or you're buying that space, you've got 3 really important conditions that are in your favor. You can also use the SORT report as a starting point to explore specific stocks within a sector that's showing strong signals. For example, if U.S. technology, which is right here right now with 2 of 3 green, if U.S. technology lights up with 3 green in the weeks ahead, it might be time to consider drilling down and looking at some of the tech giants like a Microsoft or like an NVIDIA. You could also use the SORT report to manage your investments strategically, reallocating your portfolio based on data-driven insights rather than gut feelings or what the latest guy in a suit is talking about on CNBC. For the next 2 weeks, through December the 15th, today's the 1st, we are offering a free 30-day trial of our Substack offering, which also includes our existing weekly Asbury Research chart focus and also the new SORT report. So basically what we're doing here is adding an additional report, the SORT report that you're looking at right now, to our Substack offering for no additional charge. If you're already an Asbury Research Substack paid subscriber, you will now also get the SORT report for no additional charge. If you're not a Substack subscriber, then you can sign up for a free 30-day trial of both reports, which are, again, they're part of the same package. And then after the 30 days, if you wish, you can choose to become a paid subscriber. To sign up for this 30-day trial, look for the Substack link that is underneath this video. There's going to be a series of links there, so look for the Substack one and you can sign up there. So there it is. That wraps up Asbury Research's Following the Money podcast for this week. Our next Following the Money podcast is tentatively scheduled for Sunday, December the 15th, 2 weeks from today. If you like our approach to investing, we can help you with either data-driven research. We have a couple of different research products. We also have a premium research product, or money management that implements my 40 plus years of experience in the financial markets and blends in our own data-driven models. You can request more information about us by going to asburyresearch.com, which we're going to go to right here. There we go, asburyresearch.com. Right here. Here's the contact tab to contact us. And that's it for this week. Enjoy your holiday season. Thanks for listening, and I hope to see you here again soon. And please don't forget to like and subscribe.